Imagine checking your investment account and seeing green. Again and again, week after week, month after month. It starts to feel normal, almost inevitable. Every dip gets bought. Every scary headline fades away. Every crisis somehow turns into another buying opportunity. At some point, you stop asking why, because the market always comes back. But here's the uncomfortable question. What if the world's biggest bull market isn't being powered by unstoppable economic strength anymore? What if it's simply running on momentum, optimism, and the belief that someone else will keep buying? History has a strange habit. Bull markets rarely die because people stop believing. They usually die when almost nobody can imagine them ending. And that's exactly why it's worth asking whether this one is running out of fuel. For more than 15 years, investors have lived through one of the greatest wealth-creating periods in modern history. Since the financial crisis of 2008, major stock markets, especially in the United States, have climbed to heights that once seemed impossible. Companies became trillion-dollar giants. Artificial intelligence created a new investment frenzy. Technology firms grew larger than entire national economies. Millions of people who simply held index funds watched their savings multiply. If you entered the market after 2009, you've experienced something unusual. You've lived through a generation where buying almost any major dip was rewarded. That changes how people think. It changes how companies behave. It even changes how governments make decisions. Because success has a way of convincing everyone that success is permanent. But markets don't move because of confidence alone. They need fuel, real fuel. And every bull market is powered by a combination of forces. Growing profits, cheap money, expanding credit, strong consumer spending, innovation, and perhaps most importantly, people willing to pay even higher prices tomorrow. Imagine a rocket. The higher it climbs, the more fuel it burns. Eventually, the question isn't whether the rocket is impressive. It's whether there's enough fuel left to keep climbing. That's where today's market becomes fascinating, because many of the engines that powered this rally are beginning to change. Start with interest rates. For years after the 2008 financial crisis, borrowing money was unbelievably cheap. Central banks around the world pushed rates close to zero. Why? Because cheap money encourages borrowing. Businesses expand. Consumers spend. Investors search for higher returns. When cash earns almost nothing in the bank, people naturally buy stocks instead. Money flows into financial markets. Asset prices rise. Everyone feels wealthier. That wasn't an accident. It was policy. Low interest rates became the invisible foundation beneath one of history's biggest bull markets. But foundations matter most when they begin to crack. Inflation changed everything. After the pandemic, prices rose much faster than expected. Central banks had little choice. Interest rates climbed at the fastest pace seen in decades. Suddenly, money wasn't free anymore. Businesses faced higher borrowing costs. Homebuyers saw mortgage payments explode. Governments had to pay far more interest on their own debt. Even investors faced a different calculation. If government bonds suddenly offer attractive returns with relatively low risk, why chase expensive stocks? That's a question markets haven't had to answer seriously in years. Then there's corporate earnings. Stock prices eventually depend on one simple idea. Companies must keep making more money. The problem? Expectations have become enormous. Many of today's largest companies aren't simply expected to grow. They're expected to dominate entire industries. Artificial intelligence has become the newest source of optimism. Every earnings report seems connected to AI somehow. Chip companies, software companies, cloud computing, robotics. Even businesses with only a distant connection suddenly mention artificial intelligence dozens of times during investor calls. There's a quiet irony here. Sometimes companies earn excitement long before they earn profits. Markets often price in tomorrow's success years before tomorrow arrives. That works beautifully until reality has to catch up. Think back to previous investment booms. Railroads, radio, the internet. Every one of those technologies eventually transformed society. But many investors still lost fortunes because being right about the technology isn't the same as being right about the price. That's an expensive lesson markets love repeating. Another engine behind this bull market has been share buybacks. Here's something surprisingly simple. Imagine a pizza cut into 10 slices. If 4 slices disappear, your remaining slice suddenly represents a bigger share of the whole pizza. Companies do something similar. Instead of issuing more shares, many buy back their own stock. Fewer shares remain. Earnings get divided among fewer owners. Earnings per share rise. Investors often reward that. Over the past decade, some of the world's largest companies spent hundreds of billions of dollars buying back stock. That supported prices, sometimes dramatically. But buybacks become harder when borrowing costs rise. If debt becomes expensive, companies may think twice before using borrowed money to repurchase shares. One more source of fuel starts weakening. Now, consider consumers. Because consumers quietly power enormous parts of the global economy. When people spend, businesses earn revenue. When businesses earn revenue, profits rise. When profits rise, stock prices often follow. Simple. Except consumers aren't unlimited. Many households are dealing with higher food prices, higher insurance costs, higher rent, higher credit card interest, higher mortgage payments. Eventually something gives. People delay purchases. Vacations shrink. Restaurants become occasional treats instead of weekly habits. Small decisions made by millions of families become enormous economic forces. The economy doesn't collapse overnight. It simply slows. And slowing matters when investors have already priced imperfection. There's another piece most people overlook. Market concentration. Today, a surprisingly small number of giant companies account for an enormous share of stock market performance. If those companies keep rising, the entire market looks healthy. If they stumble, the entire market suddenly feels fragile. Imagine balancing on one giant pillar instead of 10 smaller ones. It works, until it doesn't. This concentration creates an illusion. Indexes may reach record highs, even while many individual companies struggle underneath. That's why headlines don't always tell the whole story. Then comes valuation, a word that sounds boring, but quietly controls everything. Imagine buying a coffee shop. Would you rather pay 10 years' worth of profits? Or 50? The better business isn't always the better investment. Price matters. In stock markets, investors sometimes become so optimistic that they're willing to pay extraordinary prices for future growth. Those prices assume almost everything goes right. Profits must keep rising. Interest rates must cooperate. Consumers must keep spending. Competition must stay manageable. Nothing major can break. That's asking a lot from reality. History suggests reality enjoys disappointing perfect expectations. Of course, none of this means a crash is inevitable. Markets don't operate on schedules. Some continue much longer than almost anyone predicts. Innovation continues. Businesses adapt. Productivity improves. Artificial intelligence could genuinely transform entire industries. Economic growth may surprise everyone. That's entirely possible. The point isn't certainty. It's probability. The higher prices climb relative to fundamentals, the smaller the margin for disappointment becomes. Think about mountain climbing. Near the bottom, a small mistake isn't pleasant. Near the summit, the exact same mistake becomes dangerous. Height changes consequences. Markets work the same way. Perhaps the biggest risk isn't valuation, or interest rates, or inflation. It's psychology. Bull markets slowly teach investors the wrong lessons. People begin believing risk has disappeared. Cash feels useless. Patience feels outdated. Speculation starts looking intelligent. Eventually, investing becomes less about owning productive businesses and more about assuming someone else will pay even more tomorrow. That's when fuel quietly changes. Instead of earnings driving prices, prices begin driving optimism. Optimism attracts buyers. Buyers push prices even higher. Higher prices create even more optimism. It's a feedback loop, an exciting one, until it reverses. Because fear compounds just as efficiently as greed. The remarkable thing is that nobody rings a bell at the top. There's no announcement, no official ending. Bull markets usually appear strongest just before confidence begins to crack. The headlines remain optimistic. Experts stay confident. New records keep arriving. Then one unexpected event changes the conversation. Not because it causes every problem, because it exposes problems that were already there. That's why asking whether this bull market is running out of fuel isn't really about predicting next month's stock prices. It's about understanding what has powered this extraordinary journey in the first place. Cheap money, expanding credit, growing profits, aggressive buybacks, optimistic consumers, powerful technology, investor confidence. Some of those engines are still running. Some are slowing. Some may eventually restart. The challenge is that markets rarely need every engine to fail. Sometimes they simply need one important engine to weaken while expectations remain impossibly high. And perhaps that's the most interesting question facing investors today. Not whether the world's biggest bull market will end. Every bull market eventually does. The real question is whether we're still climbing under the power of solid economic fuel, or whether momentum itself has quietly become the last engine still burning.